Welcome back to the IB Investor channel. In this video, we'll go through Garo's second quarter for the year. They still have another 10 days before the Q3 report is released. So up until then, this is the best numbers that we have right now. In this video, we'll cover the share price development, we'll cover the sales and profitability, the cash flows, the debt situation, the CEO remark. However, in this video, we'll not cover the short interest here for this company because when I checked, it was less than 1% of the total float being shorted. So I just figured, yeah, it's not worth it for this video. Now this is another one of those stocks that, have had a pretty rough time, I would say. Shareholders obviously holding it for long term, who held it for, the maximum period here, have received a return of 60%. Which is kind of okay, I guess, in this type of market environment. But you have to remember it's been many years here. We're looking back at probably 2016. But shareholders, who bought here recently, as you can see, have lost a lot of money. So if you held it for 3 years, you're down almost 70%. For the 1 year or past 12 months, or rolling 12 months, you're down, 71% plus. If you just held it this year, you're down almost 70% as well. And it's just been a rough ride for any investor who pretty much bought it all the way down. So yeah, pretty rough. We can also see here that there are currently just above 12,000 shareholders here at my brokers. So quite a common stock to hold, I would say. Not the most common, but not the least common either, but pretty common, I would say. But yeah, rough ride is the summary here for the past time here. Now for the income statement for this company, we can see the net sales here in blue, which has been steadily increasing for every past year, as we've seen here on the graph, which is very good. This is something that investors like to see, and also shareholders, obviously. The negative point here is the EPS, as we can see, grew nicely here, or here actually was kind of stagnant, but here it grew, for the long period here up until 2021. And then we've seen a decline here, 2022, and back to back here for the most recent quarter, a decline of, more than 50% from the top levels here. So this is quite alarming and not very good to see. We can also see here the gross margin here that sits at 45.4%, which is actually a pretty good starting, gross margin. It's nothing wrong with having 45%. In my book, it's pretty good for an industrial company. But it has been as high as 50.4% here in 2021, so it is in decline as well. We can also see here the profit margin here that currently sits at 5.2%, which is, it's not razor thin, but it is pretty thin. And it did peak here actually in, we have to go back quite far, but it peaked here in 2017 at 10.8%, so almost or more than double that of current profit margins. So this company did in the past have some potential here to make a lot of money, but they have to get back to, the 10% or double digit profit margin, I would say, before this company is a real turnaround, because historically speaking, it's been around that level for some time, or around that level. So it's just here the past, 2 years or something like this where it's just not good enough right now. So management has some work here to, expand their margins here, at least the profit margins here going forwards. Now looking at the free cash flow margin, and we can see it right now, most recent quarter, it is negative, which is bad. We've also seen our 2022 has been negative, but in the past they've had some years, or many years actually, where it's been positive. So management must get back to this, positive side of things, because that's what investors, potential investors, like to see, where they have a history of positive free cash flow margins here. We can also see some peers here. AdTech that currently sits at 7.1% and Lagercrantz at 9.8%. So, this company, the management here of this company has to drive the margins much higher here. This is not acceptable if you want to invest in this company right now. We're not going to spend so much time on this, but this is the free cash flow per share, and it paints pretty much the same story here as we saw in the previous picture here, with a negative, free cash flow per share in kroners. So not a good view, I would say. They have to improve it. Now for the cash flow overview, and we can see here in the past, it's been growing pretty steadily and nicely. From this year to this year here, in just 2 years, they doubled the cash from operations in blue here, which is very good. Then it's been a bit stagnant here for these periods here. However, now for the most recent quarter, we can see that they posted a negative cash from operations, which is very, very bad to see here. So yeah, they have to improve it. We can also see that capex in the orange bar here is also quite negative, and here is certainly very negative here. So, management must do something here. The investing part is too heavy, and at the same time, the free cash flow here in green one, negative 170 million kroners, it's super bad. They have to get back on track here where the free cash flow in kroners is positive again. But certainly the cash from operation right now is very important to improve, because a negative one at 6.2 million, it's not very good, especially not for investors or speculators on the side such as myself looking at this stock. It's just, this is bad. Now looking at the net debt versus the cash from operations again. So the blue line here is the net debt, and we can see that they had some years here and years here where it was negative, which is good because that indicates that they have more cash than debt. Yeah, for for these years, the net debt has just been spiraling out of control, I would say here, at least for this year, for the most recent quarter here. This is okay, as long as they're posting cash from operations that almost covers the net debt. So in this time, they would have covered it in, less than 2 years, no problem. But here, there's a lot of uncertainties. When you don't have any positive cash from operations, will you ever be able to pay off this debt? I don't know. But that's a question, for both the investors or shareholders holding the stock, but also management here. What is the plan here? Because if you have negative cash from operations and your debt is obviously more than doubling, that looks very alarming from the side point of view, at least here, sitting on the bench here looking at the company here from the side. But yeah, it doesn't paint a very good picture right now. Now looking at the net debt to EBITDA, we can see that currently the company sits at a 2.3 times multiple, which is way higher than in the past. We've had some negative periods here, which is very good, but some, positive periods here, which is not that alarming. If you have less than 1 times, it's normally not an issue. But this is where I see some issues, where it's just increasing by quite a lot, as we saw in the previous picture with the cash flows and the net debt. It is kind of worrisome, that it's increasing so much, and I don't know if it's going to be worse. So it's going to be quite interesting actually to follow the next coming quarters here to see whether or not this number will increase by much more, or if it will just remain at the same levels. But yeah, we'll see in future videos whether or not that's going to move or not. But right now, 2.3 times multiple in itself, it's not worrisome, but we need to see development here going forwards before I can make any judgment really. And just comparing it apples to apples, AdTech at 1.6 times and Lagercrantz at 1.6 times as well, net debt to EBITDA here. But just comparing it apples to apples, no other KPIs. So yeah. Looking at some more valuation metrics here, we're looking at the enterprise value to EBIT, and we can see that the company currently trades at a 21 times multiple here. And I would say that, even this figure here for this company right now, when I look at it, looks pretty rich in my opinion. We've had periods though, where the company traded at much higher multiples here. So this is certainly, it just screams overvaluation in my opinion, because this is not a tech company. It's never had, 80 or 90% margins, or 40 or 50% profit margins, but rather razor thin margins all across the board almost. So I don't think this company, deserves these multiples and not even this multiple here, but we have to remember that during this period, I don't know if you remember, but we had Tesla, we had all the sustainability companies, all the companies within electrification. They received crazy multiples here, and Garo was obviously one of those companies that received some of that premium valuation, and we can see it here in the number for the EV to EBIT multiple here, just going out of control. This is more reasonable, 15, 16 times or something like this. And then just comparing it to some peers here, AdTech at 20.5, Lagercrantz at 20x as well, which is kind of expensive too, but these companies are at a much different position compared to Garo right now. Now for the CEO remark, 10% growth here, 47% growth in e-mobility, 5% sales decline in Garo electrification, which is, I would just assume that Garo e-mobility is just a smaller portion of the company right now, which is why it's not impacting the net sales so much. But yeah, I don't know. They have ramped it up, it seems, under the quarter as well, successfully. They're also saying here that most of the disruptions in their supply chain has improved, which is good. So that means it's just going better. And also their deliveries within Garo e-mobility has improved as well. They probably had some long lead times down to deliver some products here to their customers, but it seems it's been going much faster. They also had some headwinds here concerning some FX at some 8 million Swedish kroners. It seems much due to the euro here, and it did press down the gross margin here in the current quarter, or most recent quarter. They also made some changes here in their facilities, organization, and marketing improvements here. Let's see, to keep up the growth and also the profitability for long term. So he's made some activities here, that we might see some effects of going forwards. It doesn't look like it's going to happen like now, but I think that investors are looking for some short-term fixes in the near term, not so much long term, because the company's financials doesn't look too good right now, in my opinion. But he's also saying here, though, that they have a big focus now on cost control and to improve the gross margins, which is good. We talked about the gross margins here previously for the income statement, and 35% or 36% or something like this. It's still pretty okay, but here he wants it to improve, obviously. And he's talking here that, or mentioning here that it will be through mostly increased production efficiency and also some price adjustments here. They also have new production facilities and logistics facilities in Poland, and apparently they have been completed in time and started, he started to use them, or the company started to use them here in July month. And most of the Polish production then has been moved from their current facilities and into the new one. And they're also looking here to divest the old facility then probably, and looking to get somewhere at 45 million SEK or something like this. Continuing here with the CEO remark here, and he's saying there are some headwinds here, especially for the Nordic market here for smaller houses and apartments. He's also saying that in the long run he sees some positive effects within their business, because most cars will change from combustion engines to more sustainable, probably electrical driven or electrical powered vehicles going forward. So he's obviously looking forward to that trend changing as it goes, but for many quarters here it is expected to be weak for smaller houses and apartments. There are some social construction buildings that might still happen, he's saying here, and also in combination with some renovation and some energy efficiency changes, it could be good in the short term still, but some headwinds, obviously, I would say, when judging or assessing this CEO remark. All right, this was it for this video. Please bear in mind that this was the second quarter of 2023 and not the most recent in Q3 here, because it's going to be released here in 10 days. So yeah, please bear that in mind when watching this video. Anyways, thank you very much for watching, and if you liked the video, please hit the like button and subscribe for more content. Thank you very much. Bye bye.